Okay, in this video we're going to cover the Producer Price Index. This is a price index that measures inflation, but unlike the Consumer Price Index, which looks at inflation for goods purchased by consumers, this index looks at inflation for goods purchased by producers, businesses. And it breaks it down into various tables. The first one, Table B, shows the 2018 here in the respective months, and then 2019 in January. And then you'll notice at the top it says processed goods for intermediate demand. Well, a processed good is a good that has already been produced to a certain extent, but is still intermediate in that it's a good that's going to be processed further. Some examples would be flour, right? Flour is a good that is processed from, say, wheat. Okay, so there's some production, but we know that flour is going to be further processed into cookies and cereal and things like that. Another example of a processed good for intermediate demand would be leather. Well, leather comes from the hides of cows. So there's some processing involved, right? You don't just go out in nature and leather is laying there. You have to slaughter a cow, and then you have to take the hide and do all sorts of things with it in order to turn it into leather. And it's intermediate. It's a processed good for intermediate demand because that leather is going to be sold to a business that ultimately makes leather couches and leather jackets and all sorts of things. So remember, process means, we've added some value to the good itself. And you'll notice the totals here. So for January 2019, it looks like we had a 1.4% drop in the price. So we had some deflation in January of 2019. Then it breaks it down, the total, into food and feeds. So these would be, like animal feed, things like that, and energy prices next. Okay. So notice the parallel with the CPI. In the Consumer Price Index, we separated out food and energy to derive the core CPI and get a more stable inflation metric over time, because food and energy are volatile components of the CPI. It's no different here. Food and energy represent volatile components. And so if we want to factor those out of the total, then we do so, and we get this here. We get a negative 0.3. So notice the deflation wasn't as significant when you removed food and energy, which makes sense because you'll notice energy especially had a high amount of deflation. So if you remove that out, you're getting less deflation overall. The core producer price index here for processed goods would be what the government focuses on, right? So they can start to spot trends. All right, unprocessed goods for intermediate demand. Well, unlike processed goods, these are goods that are pretty much just removed from nature, okay? And examples might be coal, iron, oil, wheat, cattle, timber, soybeans. I mean, there's very limited processing involved. And as a result, we call them unprocessed. Another term that's often used for these is crude goods. So take a look at the changes. It looks like for total unprocessed goods, we saw a drop of 9.3% in January. And then if we look at foodstuffs and feed, down 0.5%, energy down 19%. If we back out food and energy from this total, we end up with negative 1.9%, which essentially means we had a little bit of deflation in the core unprocessed goods. So firms that were buying things like coal, wheat, cattle, timber, they found lower prices in the month of January than December. Also note that the deflation of the overall unprocessed goods was significantly more than the deflation in the core, just like we saw for these processed goods over here. This is a result of energy prices again. Energy prices fell a lot for unprocessed goods and processed goods, causing the core to show less deflation than the overall. Because remember, the core, you're actually removing this energy component. So whatever deflation was here gets factored out by removing the energy. Okay. And then over here it shows us the change from 12 months ago. Okay, so negative 3.1. So it looks like a lot more deflation from January 2018 to January 2019 in unprocessed goods when compared to the same time frame for processed goods. Okay, let's go on to the next table. This is table A. Let's see here. And now we've got similar structure, but we're looking at final demand goods. Okay? These are goods that are bought by firms, right? Because we're still in the PPI, so we're only looking at things that firms buy. But these are goods that are pretty much processed completely. They're ready for sale to the consumer. So you can imagine some of the businesses that would buy these, like IKEA. IKEA would buy furniture to put on the shelves in order to, sell to the consumer. Vaughn's would buy meat to put on the shelves for you to buy at the grocery store. Chevron would buy gasoline to put at the local station for you to buy. So this is the closest you get to the consumer in terms of goods, but the producer is the one doing the buying. It's one step before we get to the consumer, which means we're one step away from the consumer price index, right? All right, so let's look at some of the results. Well, we've got final demand overall, and you'll notice in January 2019, it was negative 0.1, so almost no change in inflation or deflation there. If we remove food and energy, we get 0.2, a little bit of inflation. Okay? And then you've got final demand goods and final demand services. Okay? If we focus on final demand goods, it looks like we had a negative 0.8% in January. Foods went down 1.7%, and energy went down 3.8%. Okay? If we remove food and energy, we get 0.3. So it's, similar pattern, right? You're seeing large energy drops that is in prices that's affecting the processed, the unprocessed, and the final demand goods. So just about everything that firms are buying related to energy is dropping significantly in price. And that is showing up with a core producer price index that is higher than the overall total. So we get some deflation here, but actually show inflation in terms of the core because we remove those deflationary elements. For services, we actually get 0.3% inflation. And then for trade services, 0.8%. Transportation and warehousing, 0.5%. And then other, no change. When you think of services, you've got to think of intangibles, right? Everything we've looked at so far has been tangible. Processed, unprocessed, and final demand goods are all tangible things. You can wrap your fingers around them. They're physical. Services are not. So trade services, people providing you a convenient location to pick up your good. Transportation and warehousing, people driving around your good from one place to another, and a whole host of other things there. And then you've got the change in final demand from 12 months ago. So a little bit of inflation here. Okay. And then if you want to remove food and energy, you can get the 2.5% here. But the most important thing to note from this report is these stages, right? We started out with a stage that was unprocessed. Okay. Then we got processed. And finally, we get final demand and services. So we're inching towards the consumer, which is why the producer price index becomes a leading indicator for the consumer price index. So if we see, for example, the price of oil going up in the producer price index, a crude unprocessed good going up in price, then that suggests that we'll see the price of plastic go up in the producer price index, a processed good, which tells us that eventually we would expect the final demand for toys made out of plastic to go up in price. And it's not that hard to extrapolate and recognize that toys are part of the CPI when the consumer buys them, and they're going to be more expensive as a result. So the producer price index serves as a leading indicator for the consumer price index. Last thing I want to do is something similar to what we did with the CPI, where we think about a business spending on inventory. And imagine, because of the price increases, how much more spending they would have to do in order to get the same amount of product. If you recall, we did this for the consumer price index, where we looked at a consumer that is spending $30,000 a year, and to get that same basket after the inflation, how much more would they have to spend? Now we're just going to do it for a business. So let's say that Kohl's, a retailer, looks at the increase in the final demand from 12 months ago, and they see that it's 2% higher. Right? So let's imagine that they're accustomed to spending $1 million. So we're going to put $1 million in here on inventories. Okay, so that's how much they spent in January of 2018. Okay. Well, this 2% here is from January 2018, right, 12 months ago, to January 2019. So how much more would they be spending now? Well, we use the formula of multiplying the amount on inventory they're spending times 1 plus this inflation rate. So we're going to take 1.02, right, because 0.02 is the decimal form of 2%. And enter, and that means that they would be spending $1,020,000 now in order to buy the same amount of inventory that they in January 2018 spent $1 million on. So essentially their costs have went up by $20,000 for inventory. Okay, so that's the way we do those calculations. All right, that's it for this report. If you have questions, let me know. Thanks.